and we'll be working on that for today. So the first question is on what's this? Company financial statements. So we'll start with that. So with the company financial statement, this is the information that they've given us. This is the information that they've given us, and they're saying this information relates to DBN Limited. The company sells household products, and the financial year ended on the 29th of February 2024. Okay, so we have our financial year there, and then it requires that we need to, for 1.1, we need to refer to information A. The bookkeeper has recorded all the entries regarding fixed assets in the books. Complete the amounts denoted from 1 to 3 on the fixed asset note. So this is us. This is the question testing our tangible assets. So let's look at information A. So they've given us the fixed asset note. Then they've told us the following. Depreciation is calculated as follows. Vehicles at 15% per annum and equipment at 20%. The vehicles is on cost and equipment is on the diminishing balance method. Then the next part is that a new vehicle was bought on the 1st of October 2023. And then this is the extract from the fixed asset register in respect of the equipment sold. So there's equipment that has been sold. Okay, we're just focusing on the information that has been given in part A. So let's continue. Now for the first one, what do they want us to calculate? As you can see, it's under buildings. Number one is under buildings. They want the cost at the beginning of the year. What have they given us in the information? The carrying value at the end of the year, and also our disposals during the year. There were no additions. So now we are going backwards, back to the beginning of the year. So if we want the cost at the beginning of the year, we need to reverse what has happened for us to get to our carrying value at the end of the year. And remember, our cost is the same as the carrying value when you are dealing with land and buildings because they do not depreciate. So you don't need to worry about depreciation there. So we have 9,421,300. And to get to that, we needed to minus 420,000 because that building was sold. So now if we're going backwards, we need to then add to get our opening balance. What do? We take the 9,421,300 and we add the 420,000. And that will give us our what's this? Our cost price at the beginning of the year. And for 2,300 plus 420,000, and that should give you 9,841,300. Okay, any questions with that one? Everyone good?
I think we're still good. I'm trying to follow. I just joined in.
Okay, but we hadn't started when you just joined. So this is just the first thing we've done. This is our first question we've done. So what we're doing here is calculating the cost price at the beginning of the year. So that means we're using the carrying value at the end and we're going backwards. So as you can see, the 420,000 here was a minus. So if we're going backwards, we need to add it. That means to our carrying value to get our opening balance at the beginning of the year. Are you caught up now, Octavia?
Oh, yes, yes. But
Okay.
where did we get the first one for the calculation for the is the building in the beginning of the is it 9,421,000 plus 42 or 420,000? Where did you get this from?
Where did I get them?
Yes.
In our note here. Under buildings.
Oh, okay. Thank you. I see now.
Okay. Are you good now?
Yes, I'm good. Thank you.
Okay, then let's continue. So next up, we have the depreciation of vehicles. We need to calculate the depreciation of vehicles. So how do we do that? This is the information we've been given on vehicles. We have the carrying value at the beginning of the year. We have our additions at cost. There hasn't been any disposals. And then we need to calculate depreciation. And they also gave us cost at the end of the year. Now, we have two types of vehicles. We don't have any disposals, but we have new vehicles and we have old vehicles because we have sold something. So then that's why we need to, what's this? Calculate depreciation of vehicles separately. Calculate the new vehicle separately. Calculate the old vehicles separately. Now they told us that vehicles is calculated at 15% per annum on cost, meaning we don't need, what's this? We don't need the accumulated depreciation. We just need the cost of the old and the new. Now let's start with the easier one, which is the new one. It's been given there that it's 260,000. And then we're told this was purchased on the 1st of October 2023. If you remember from our background information, we're told that our year ends on the 29th of February 2024. So this was not purchased at the beginning or at the end of the year. It was purchased during the year. So what I do advise always for this is for you to draw a timeline. So let's do that. This is your timeline. Your year starts on the 1st of March 2023 and ends on the 29th of February 2024. The purchase happened on the 1st of October 2023. This is how long we have had this, sorry, this is how long we have had this vehicle, meaning that's when we start calculating our depreciation. Does that make sense? So what do we do then? Since we are starting there for calculating our depreciation, we take the 260,000, take the 260,000, we multiply that by the 20%. But because this did not depreciate for the full year, we need to count how many months did it depreciate. So this is from when it was purchased till the end of the year. So it will be October, November, December, January, February, making it 5 months. So then we'll multiply this by 5/12 because the 20% gives you depreciation for the full year. But as we know, for this, it did not depreciate for the full year. So we need to
And
apportion. Hello?
it's not 20%, it's 15.
Oh, sorry. 15, sorry. Thank you for that. That's 15. That's correct. It's 15%. Thank you. Okay. Any, does anyone have a question? Okay. If you don't want to unmute yourself, you can always type in the chat box. Okay, I'm gonna assume no questions. So for the new vehicles, that'll be 260,000 times 15% times 5 divided by 12, which will give you depreciation of 16,250. Now, we don't have the cost for the old vehicles. As you can see here, it's empty. There's nothing here. They gave us the carrying value, but it's not like we have the accumulated depreciation at the beginning of the year to calculate the carrying value. But what else did they give us? They gave us the cost at the end of the year. Now, with the information we have, what do you guys think we can use to calculate our cost at the beginning of the year for our vehicles? All right, I'll continue. So let's say we were doing the T ledger for vehicles. So we start off with our opening balance. the opening balance, whatever that amount is, and then what happened during the year purchased vehicles. So bank. So how would we get the closing balance there? How would we get the closing balance? Let's say we have the opening balance, we have what we purchased. How would we calculate the closing balance for a T account for vehicles? So we would just add up these two, then balance. That would be your closing balance for vehicles. Now, in this case, and the one that we have been given, we have the closing balance of our vehicles. We have also what was purchased. So what can we do? Debit minus credit. So we are given here 786,000. Then we minus the 260,000. And that will give us our vehicles. So that will equal 786 minus 260,000 will give us 526,000. So we take the 526,000 and we calculate our depreciation on that. So that will be multiplied by 15%, 526 times 15%, and that will give us depreciation of 78,900. Then you add it together with the new vehicle's depreciation. So that would be 16,250 plus 78,900 to give you a total of 95,150. Does anyone have a question about how we got to our depreciation for the year for vehicles? Whether it's in the new vehicles or old vehicles, any questions? Hey guys, it's important that you guys also. Okay, I'll just wait. Someone's typing.
Oh, okay. I do so. Thank you.
Okay.
Ma'am, could you kindly please explain the new cost and the additions at cost? You said something about subtracting the 786,000 minus the 260. I
Okay.
did not understand that.
No problem. Hey, let's say we were doing. You guys are familiar with the T ledgers, right? The T ledger for vehicles. Let's say you were doing T ledgers for vehicles. So what do? It's an asset account, so your balance is on the debit side. So you start with the balance. Let's say it was 100,000. You're just making an example. Then the information they tell you you bought versus vehicles. So you are increasing your vehicles on the same side. So you put it on the credit side. Debit side. Let's say you bought 50,000. Now, let's say they were asking now, what is the closing balance? What would you do? You would total up the side, have 150,000, then total up the credit side, have 150,000, and then your closing balance would be 150,000, and you would have to bring it down. Okay, does everyone get me to that part?
Yes.
Okay. Now, the thing that happened with this question is that we are doing the reverse. We are calculating what the opening balance is. What they've given us is the closing and what was purchased. So now if we're to replace here, we have the closing as 786,000 and the purchases are 260,000. Those are our additions, what we purchased on vehicles. And they haven't given us the 100,000. So if we're still using the old example, to get the 100,000, what will we do? We say 150,000 minus our additions of 50,000, and that gives us our, what's this? Our opening balance of 100,000. So it's the same thing here. We take the 786,000 minus the 260,000, and that gives us the 520,000, which is our opening. Yeah, is it making sense? Okay. Thank you, Vanele. Is everyone good? Joy, Xavier?
I'm good.
Good.
I'm okay, thanks.
Okay.
I'm good.
Okay. Is everyone's question now answered with the whole depreciation, or did you mention something else that I forgot? Okay. If there's nothing else, I'll continue, but you guys can always type in the chat or unmute yourselves. Now, the third question says calculate the carrying value on equipment sold. Okay, so let's look at equipment. They're giving us 436,000. Sorry, they're giving us 436,000 as our opening cost. There were no additions, but there was a disposal, and then there was also, what's this? 32,000 was the depreciation, and then 356,000 was our cost at the end of the year. Now, what they gave us was the fixed asset register in respect of the equipment sold. So that means we'll just be using this to calculate our carrying value on the equipment sold. So what have they given us? Information they've given us here, the cost price. We purchased this for 80,000 on the 1st of September 2021, and we sold it on the 31st of May 2023. Then what's the relevant information here? This was the carrying value on the 28th of February 2022, and this was the carrying value on the 28th of February 2023. Now remember, when does our year start? On the 1st of March 2023, which is the day after the 28th of February 2023, meaning this was our carrying value for the equipment sold at the beginning of the year. Now, timeline, always 1st of March 2023. This was sold on the 31st of May 2023. Our year ends on the 29th of February 2024. Okay. Now, for something that's being sold, it's the opposite to something that's being bought. You count the depreciation for the year from the beginning of the year up until the date it is sold. So we have March, April, May. So we had it for 3 months in the current year before it was sold. So if we wanted to calculate the depreciation for the current year, then what would we have to do? We would have to take the carrying value at the beginning of the year, which is 57,600, multiply that by the 20%, and then multiply that by 3/12, because it only depreciated for 3 months in the current year. That would give us the depreciation. So 57,600 multiplied by 20% multiplied by 3/12. And that gives us 2,880. Okay. Is everyone with me up until that point?
To be honest, I'm just on the 3 months.
The 3 months. Let's go back. Let's go back to the 3 months. We are being told this is when it was sold. So do you understand that after the 31st of May, we no longer have this equipment? We bought this on the 1st of September 2021, meaning we had it at the beginning of the year. We had it from the beginning of the year, but we didn't have it after the 31st of May. So if we're calculating depreciation, we can't calculate depreciation after we have sold it. We can only calculate depreciation in the current year when we still were using it, when we still had it in our books. So then that would be from the beginning of the year up until the end of the year. When does our year, up until the date it was disposed of. And when does our year start? On the 1st of March, and then it was sold on the 31st of May. So how do we count the 3 months? The 1st of March, so we're counting March April, and we're also counting May because we got rid of this at the end of May. So that means we've used it for the month of May. So that's how we got the 3 months. So now is the 3 months making sense?
Okay, perfect.
Yeah. Any other question? And now we have the depreciation for the current year. So if you wanted the new carrying value now, what you just do is take the 57,600 and you minus the 2,880, and that will give you your depreciation, your new carrying value, sorry, which is 54,720. Okay, any questions? Then we're done for the fixed asset part of portion of this. Now the next part says we need to calculate the correct net profit after tax for the year. So we are given the incorrect one as 1,150,000. So let's look at the information. We're told here we need to refer to information C and D. So we skip B and we need to calculate the correct net profit after tax for the year ended 29 February 2024. Indicator plus for the increase, excuse me, and a minus for a decrease next to each amount. So let's look at that. We've been given this information in C. The bookkeeper has calculated the net profit before tax as 1,150,000. And then the pre-adjustment balances to be adjusted are as follows. So we're given auditors' fees, trading stock, rent income, and directors' fees. So starting with so they tell us only the adjustment listed below must still be taken into account. And then they tell us audit fees of 45,600 are still owing on the 29th of February 2024. Now remember from the previous lesson or from your accounting lessons, if an expense still hasn't been paid, or they tell you still hasn't been paid, that's an accrued expense. You need to include it as part of this year. Just because it hasn't been paid does not mean it's not part of the current year. So your income and expenses, you include them once you've earned and incurred them. It's not about when you pay or when you receive the money. So that means that 45,000 needs to be added. So we'll write down audit fees for this adjustment and we are adding 45,600. Questions? Okay. I assume no questions. So next part. They're telling us that a donation of 100 blankets was made to a children's hospital, but the donation has not been recorded. The business uses the weighted average method for valuing blankets. The stock records for the blankets reflected the following. So this is an inventory calculation. Okay, so we need to calculate a donation. Donation, you put it as part of your expenses. Um, sorry guys, let's go back to the audit fees. Yes, you would include them as part of your audit fees, but remember that's increasing an expense. So if you increase an expense, what does that do to your profit? It decreases it. So we need to minus the 45,600. Sorry about that. Forgot to explain that part. But is that making sense to everyone? I can repeat that if you want. Okay, let me repeat it. We are increasing audit fees. That part is not incorrect. We need to increase our audit fees. But then what is audit fees? An expense. And how do you get profit? Profit is income minus expenses. So if we increase expenses, we're increasing the minus. Is that making sense? Yeah, minusing. We're decreasing our profit. Questions? Eh, what's your question? Oh, are you saying you're good or do you have a question? Sorry. Joy, Octavia, you guys good?
Sounds so good.
Sorry? Okay, so I'll continue. Will we? The next part, the donation. So we're using the weighted average. So let's see. We are looking for the donation. Donation of 100 blankets. So we need to calculate what the weighted average cost is. So now for when you're calculating the weighted average cost, what you need to do, don't look at your closing, but what you need to do is take your opening plus the purchases. So it's the value at the top of those things. And then you divide by your number of units. So let's see here. So they have purchases during the year, the sales, and the stock on hand. So they had no opening stock. So we'll be just using the purchases information. What you'll do here is take what the purchases, the total cost is at the top, which is 603,000. And you'll divide that by 1,500 because we don't know where these donations are coming from, whether they're coming from the goods on the 15th of April or 22nd of June. So what we need to calculate the average. So value at the top, divide by the number of units because we want the price per unit. So that is 603,000 divided by 1,500 to give us 402 rand a unit. So now that we have the per unit price, we can calculate what our donations will be. So the donations will be 402 times the 100 blankets. That will give us the cost of the cost of the donations blankets. Now, remember, it's an expense. So an expense, guys type in the chat, do we add or subtract expense from our profit? Plus or minus?
Subtract.
We subtract. That's correct. So we need to minus the amount we'll get here, which is equal to 40,200. Okay. And then this donation is not just going to affect our profit, it's going to affect an account we have here called trading stock because we had this amount of trading stock, then some of it was donated, so we need to decrease that by the 40,200. Okay, this is just us noting in case we need, sorry, this is us just noting in case we need something to do with the trading stock because, trading stock deficit and stuff, so we don't know. That information might be relevant. Then let's continue. Rent was increased by 1,300 per month from the 1st of January 2024. Only the rent for the period of 1st March 2023 to 31st of January 2024 was received and recorded. Meaning the rent here is for 11 months. It's not for the full year. They haven't recorded, what's this? They haven't recorded February's rent. So we need a timeline for changes. I'll say a lot with our questions. Timeline, timeline, timeline. Most of the things need a timeline. So 1st March 2023, our year ends on the 29th of February 2024. Then what happened? On the 1st of January 2024, we increased rent by 1,300. We only stopped paying rent on the 31st of January 2024. Okay, so that's the information that's relevant. Now, let's see. Meaning before January, we had a different price for rent, and then after January, we had the different price plus 1,300. So how long was the price different? For 10 months, we were paying a different price, and then for this 1 month, we're paying the normal price plus 1,300. Is everyone with me up until that point? No. Now continue. So 10 months, we're paying something different. Now in January, we're paying something different. And then that all totals to 287,300. So let's just keep the M as what the price would have been. So 10 months, we're paying something. And then for that 1 month, we're paying an extra 1,300. And that gives us the 287,300. Now we must solve for m. So 10 plus 1m gives us 11m, and then plus 1,300 equals to the 287,300. Then what we are left with is 11m. We will take this to the other side, meaning we will now minus. So that would be 287,300 minus 1,300, which will give us 286,000. So now to get our price before the increase, we just divide by the 11. So 286,000 divided by 11 will give you 26,000. So that was the rent before the increase. Now, remember, we are looking for rent in February, and rent in February is after the increase. So how do we get that? We take the 26,000 plus the 1,300, which will give us 27,300. Okay. Joy, I see that you had left the meeting for a second, so I'll just repeat. We have 10 months, and that 1 month from January has 1,300 with it. And once we add all that up, it gives us 287,300. Now, we add up our calculation. So these ones are like, what's this? Like terms. So it's 10m plus 1m, which will give us 11m, and then we add the 1,300. Now we can get rid of the 1,300 by taking it to the other side, making it a minus. That will give us 286,000. So 11 months was 286,000. This is after we have subtracted the increase. Meaning, if this is after we have subtracted the increase, what we'll get by dividing our 286 by 11, which is 26,000, will be the rent before the increase. Now, we want rent for February. Rent increased in January. So January is before February. So meaning the rent that's missing for February, that needs to include the 1,300. So after you have the 26,000, add the 1,300 to give you 27,300, and that will be your rent for February that was missing, that we need to add to our rent income. Does that make sense? I know that one was a bit of a lot, but guys have questions, we can go over it again.
It is a lot for the rent. Oh,
Okay, where did I lose you? Were you good with what's this? The timeline.
yeah, now I'm catching up on the timeline. But my worry is why do we have to add the 1.3? Like the
Because
reason for us to add that, what is it?
the reason is, okay, let's make an example. Okay, I need to start erasing. Okay, let's say when we have 2023 and we have 2024. This is December 2023, and then we have January 2024. So let's say that's how your lease ends in December, and then you have a new lease once you get to January. And that's when the landlord can increase the rent. So then what we do, we need to calculate. Let's say before rent was 1,000, and now your rent is 1,500, right? So you agree that from 2023 to
Yes,
2024, we have increased our rent by 500 per month. So our rent from
yes,
2023 per month is not the same as our rent from 2024. which is the same thing that they're telling us here, that our rent increased on the 1st of January and it increased by 1,300. So this is our 500 this side. Now, let's say in the question, they didn't tell you how much the rent was. They just told you the increase was 500. The increase was 500, but if you count rent from December and January, you get 2,500. So you'd say, okay, from December, I have that 1 month. I was just getting rent. It was just rent before the increase. And then for January, it is also 1 month, but it's plus 500. They've told me there's an increase of 500. Is that part making sense?
That's not.
Right. Are you still with me?
Yes, I'm
with
with
this
you.
calculation? So
Yes.
we don't know what the rent is, but we're using the M to represent it. So we say 1M plus 1M. And that will give us 2M and then plus
2M.
500, which will give us
Okay,
2,500. So we take the 2M, the 500, we take it to the other side, and that will give us 2,000.
1,000.
Then we divide by 2 because we want the M, which is the rent per month, which will give us 1,000. Now this is telling us this was the rent before the increase. So 1M. Because if we take that 1,000 times 1, gives us 1,000. So this is rent for December, 1,000. But for January, it's 1M plus 500 because it's an increase. So it's the 1,000 plus 500, making it 1,500. So this calculation is exactly the same as what we have done. The only difference is that they're using bigger numbers and more months, but it's the same thing. So you need to be able to recognize that same thing. Even when it's bigger, with bigger numbers, more stuff added to it, it is still the same principle. Okay. I hope now it's making better sense.
Yes, it's clear.
Sorry?
I am getting there. It's clear. But now I still have to ask something because I was calculating with you. Why here on the 2M, on the second calculation, on the 2M, actually from the first M? The first M, you said the first M, the one that you cycled, plus the 1M plus 500 Rand, which in a month we were paying 1,000 Rand, which you're going to say 1,000 plus 500, it will be 1.5. This 1M is for 1 month. Every month we are paying 1,000 Rand, which it goes to 2.5. And then on the second one, you were saying 2M plus 500. For 2M, it's 200, it's 2,000. Oh, okay. No, now it makes sense. Ask this. Thank you.
Okay. Okay. Does anyone else have a question? So if you see it here with our, I think everything was removed, but with our previous timeline now, it would have been the same thing. Just redraw that calculation. So it would have been the same thing. We have the 1st of March 2023, and our year ends on the 29th of February 2020. The increase happened on the 1st of January 2024. We added 1,300. We added 1,300. And then we received rent up until the 31st of January 2024. So as you can see, we received rent for these 10 months from March to the 1st, 2024. We received rent, and that was before the increase. And then here, this was after the increase, meaning it was 1M plus 1,300. And then they're telling us for all those 11 months, the rent in total is 287,300, meaning 10M plus 1M plus 1,300 is equal to 287,300. And this would then give us 11M plus the 1,300 equals to 287,300. Then we now go and we take the 1,300 to the other side. So it will be a minus, leaving us with 286,000. Then once we divide by the 11 on both sides, this side we're left with M. So 286 divided by 11 gives us 26,000. And that is the rent before the increase. Now, sorry, 26,000, not 260. 26,000. Now, if you want rent for February, the missing month, remember this is after the increase, meaning it's 1M plus 1,300. So it will be 26,000 plus the 1,300, which gives us 27,300. And that will be rent income. Now, rent increases our profit, so this will be plus 27,300. Okay. Then let's go over to the next adjustment. The company had one director, Jenny, at the beginning of the financial year. Jenny had been paid in advance for 2 months. A second director, Frank, was appointed on the 1st of December 2023. His monthly fee is 20% lower than that of Jenny. Frank received the fees due to him. Okay, so this is the director's fees that has been recorded, 852,000. 852,800. So with Frank, they're telling us he's received the fees due to him, meaning Frank has received his fees for December, January, February, 3 months. We can draw a timeline. Let me just okay. 1st March 2023, 29th February 2024. Then when did we hire Frank? We hired Frank on the 1st of December 2023. So Frank has been working us from the 1st of December up until the end of the year. So that's how many months he has been working. So he has received his fees for all those months. So that's December, January, February, giving us 3 months. And that's Frank. So this is Frank. Now, what they're telling us concerning Jenny is that Jenny received 2 months in advance, meaning on the 20 okay, from the previous year, meaning the year that ended on the 28th of February 2023, they paid 2 months in advance, meaning these 2 months, March and April, were already paid in the previous year. Is everyone with me up until that point? So it's like what happened is last year they paid for this year's fees in advance. They paid for March and April last year. So is everyone with me up until that point? So what we can assume is that Jenny has received her fees for the current year, but she has also received fees for the next 2 months for the next year again. So they paid her in advance. That's correct. They paid her in advance. So they're always 2 months ahead for Jenny. Meaning for Jenny in the current year, the director's fees shown here are not for 12 months, but instead for 14 months. Is everyone getting that? Okay, I'm going to assume everyone is getting that. So Jenny has received, is this a prepaid expense? Yes, it's a prepaid expense. And meaning we need to remove it from the director's fees because it's not part of this year. Questions? I think someone was unmuting themselves. Does anyone have a question before I continue? Okay, I'll continue. So Frank is fine. But the thing is with Frank is being paid 20% less than whatever Jenny is getting. So we have Frank and we have Jenny. Jenny is receiving director's fees for 14 months. And then of the director's fees, Frank is receiving 20% less of those director's fees. So minus 20% of the director's fees, and he has received those for 3 months. Does everyone understand up until that point? Anyone have a question? Jenny has received director's fees for 14 months because of the extra two, and then Frank is receiving the director's fees minus 20% for the 3 months that he has worked. Is everyone up to that point with me?
Yes.
Okay, so this is similar to what we were doing with the rent question. So we are going to take director's fees times 14 plus the director's fees minus the 20% times 3 will give us the director's fees amount we've been given here of 800 and what's this? 852,800. Okay, so we're solving for the director's fees. So this will be 14 director's fees plus, okay, so we need to multiply inside here. So this will be 3 DF minus, and then 20% times, what's this? 20% times 3 will give you 0.6. 0.6 DF equals to 852,800. Okay, excuse me. So now we'll say 14 plus 3 minus 0.6, which will give us 16.4 DF equals to the 852,800. Then if we just take the 16.4 and divide by it, 800 divided by 16.4, that will give us 52,000. Meaning that is how much we're paying Jamie per month. 52,000. Now, the prepaid expense was for 2 months, so that will be 52 times 2. So for director's fees, that will be 52 times 2. 2,000 times 2. And we are minusing those director's fees. From the expense, we are minusing, meaning what's happening, if we decrease our expense, we increase our profit. So that 104,000 will be a plus. Questions about our calculation? Is everyone good with our? Okay, so I'm going to assume everyone's good, but if you guys have a question, you know what to do. So now we can calculate our net profit before tax. So that would be 1,150,000, and then we minus 45,600, then minus 40,200, then we add 27,300, and we also add 104,000. And that will give us a total of 1,195,500. Then the next part is to calculate our taxation because we want net profit after tax. So in information D now, they're saying the assessment from SARS indicated that the total income tax for the financial year as 351,000 after all adjustments have been made. Okay, so we don't need to calculate it, we can just write it down. 351,000. So we'll We just say 1,195,500 minus 351,000. That will give us net profit after tax of 844,500. Okay. Any questions?
So, in a simplest term, if like they didn't give us the taxation of 300 and, 351,000, we would have calculated this 1,195,500 with times 100 over 115. That's what you're saying.
What they usually do is they usually tell us what the percentage for tax is. So it's usually 28%, sometimes they say 30% or 27%. So they would have told us what the percentage of tax is. So we would have taken the net
Oh,
profit before tax, multiplied by that percentage, and that will give us the tax amount.
okay. Thank you.
Yeah. Any other questions? Okay, then I'm going to assume everyone is caught up. Okay, let me just check the next part. Have enough. Okay, let's see. Okay, the next part is for us to do the statement of financial position. We are at 7:30. Is everyone okay to continue, or you guys want to stop here? Tavia, Joy, okay to continue?
Yes, I'm okay.
Okay, Joy? Oh, I think Joy got kicked out of the meeting. Joy, hello? Joy, are you caught up with us? Yeah, I think she's not she's not connected. And let's just continue with okay, the statement of financial position. So they've completed some parts for us, but they haven't done other parts. So we need to do that. So what's important here is look at your statement that's been given. You need to know the format. So just write down the format. The format is not going to change. Starts with non-current assets, then you have your fixed assets, and then your investments. Financial investment is usually a fixed deposit. Then your current assets, that's where you have your inventory and your trade and other receivables. Okay. And next up, we have our equity and liabilities. That is made up of ordinary share capital and retained earnings. Then we have our non-current liability, which is usually a loan, like long-term loan. And then current liabilities, we have trade and other payables. And then the others, now this is where things usually change. Sometimes you put the other current liabilities in part of your trade and other payables. Sometimes you'll put them separately. Things such as your shareholders for dividends, your the status income tax if it's a credit balance. What else? Then you have your short-term portion of loan. If it is in the question, you need to put it under current liabilities. Those sorts of things. And if you have a negative bank balance as well, you put it under your current liabilities. Now let's just look at the question. So we don't have inventory, we don't have trade and other receivables. Now, if we go back to the information, we've been given these balances. And another thing that we've been given is the information. Okay, this is just fixed assets, and that has already been completed, so we don't need to worry about this information. But here, remember, we had those adjustments that we needed to do. So these will also be part of our calculations. Let's start with inventory. Now, trading stock. The trading stock is given as 1,064,200. But then you remember there was that donation that was not recorded, and that decreases our trading stock, meaning then our inventory now is going to have to change. So it will be 1,064,200 minus the 40,200. So 1,064,200 minus 40,200 to give us 1,024,000. Is everyone good with that? And 4,000. Then we get to our trade and other receivables. So this will be made up of your, what's this, your debtors. Oh, you want me to repeat the inventory? Okay, let's repeat inventory. Inventory, that is made up of your trading stock. We don't have consumable stores, so just be trading stock. Now, if you remember, we had a donation and adjustment too. What does the donation do? If you donate your goods, what happens to your goods? They decrease. And we knew that the donation amount was 40,200. So we need to decrease our trading stock by that donation. Okay, is it making sense now? Okay, great. And that's how we got the 1,024,000 by minusing the donation. Then we have our trade and other receivables. Trade and receivables, your debtors, net trade debtors, because trade debtors minus your provisional for bad debts. And then it's made up of your prepaid expenses, your accrued income, and yeah, and if you have a SARS debit balance as well. So they've given us our net trade debtors here as 744,900. Then what else did they tell us? If we remember from our adjustments, we did have a prepaid expense, the director's fees, and we also did have an accrued income from our rent. Remember, we hadn't received rent yet, so that makes it an asset. We didn't receive rent for February. So that rent from February, that was how much? 27,300, and that prepaid expense of 104,000. Those will be part of our traded other receivables. So we're taking net trade debtors of 744,900. We're adding accrued income of 27,300. We're also adding prepaid expenses of 104,000. And that will give us 876,200. I'll repeat that. We are taking our net trade debtors of 744,900 plus our accrued income of 27,300 plus our prepaid expense of 104,000. And that will give us trade and other receivables of 876,200. Then now we can calculate what our total is for current assets. So that'll be 1,024,000. Oh wait, there's one thing we didn't check. Our SARS. So SARS, they said the provisional tax payments were 322,800, and this is how much we owed for SARS in the current year. As you can see, our expense was more than what we had paid for SARS. So that means we have a credit balance. So we don't need to include the SARS as part of our trade and other receivables. Okay. Any questions with that one? Okay, I'll assume no questions. So you're just adding up your current assets to get your total, which is 3,856,420. And then we add that to our fixed assets, our non-current assets, 10,377,480 to give us total assets of 14,233,900. Okay, now let's look at the other part of our statement. Ordinary share capital. Let's see from the information given here. They have it as a question mark. And then if you go here, this is where they have share capital and dividends. So they're telling us that at the beginning of the year, we had 2,120,000 shares in issue. And they're telling us at how much. And then they tell us 30 June, 230 shares were repurchased. The average share price was 5.90 at the date of purchase. Now, how do you get your average share price? You take the value of the shares in issue and you divide by the number of shares in issue. So before the buyback, we only had these shares in issue, the ones from the 1st of March. So value of the shares in issue, value divided by the number, which is in this case 2,120,000 equals to 5.90 Rand. So if we were to take this here, meaning multiplying 5.90 Rand by the 2,120,000, that will give us what the opening balance for our shares is. And that will be equal to 12 million. That will be equal to 12 million. Oh, sorry. Yes, 12,508,000. Everyone with me on that one. You can type or open your mic, either way works. Okay, gonna assume everyone sees that. So that was our opening balance. Then what happened? There was the buyback, 230,000 shares at 5.90. So we take 230. So this was start with the 12,508,000. Then we had the buyback. Buyback decreases our share capital. So that'll be 230 times 5.90, which will give us 1,357,000. Then what else happened? We are told that at the end of the year, there were only 1,890,000 shares in issue. So if we take the 2,120,000 shares minus the 230,000 shares, that should give you the 1,890 shares. So these are the only adjustments that we had, the buyback. So then our value of shares will just be opening balance minus our buyback. So 12,508,000 minus 1,357,000, which will give us 11,151,000. And that's our ordinary share capital at the beginning of the year. Does anyone have a question? Imagine if you were doing this in the note for ordinary share capital. What do? You take your opening plus any shares issued minus your buyback, and you get your balance at the end. So this is the same thing. We had no share issue, so we just take our opening minus our buyback. Any questions? It's okay if you want me to repeat something. Okay, I assume everyone's good. Then we have the retained income. So they haven't given us information on the retained income. Yeah, it's a question mark. So it's safe to assume that since they haven't given any information, this will be our balancing figure. So we need to figure out the other amounts. So what you do is, remember the accounting equation, assets equals to equity plus liability. So this amount, your total equity and liabilities need to equal your total assets. So we need to just put the 14,233,900 here. Okay. Then let's continue. What's the next part? Our non-current liabilities. Since this is a balancing figure, we need to fill this up before we come back to it. So that's why we're going to the next part. Now they've given us information on the loan. They said that this is the extract from the loan statement from PTA Bank. This is our balance at the beginning of the year, 1.4 million. Then we had repayments that included interest. Then this was the interest that was capitalized. And then the balance was 1,004,000 at the end of the year. Now, How do you get to the 1,004,000 balance? Your balance at the end of the year. You take your balance, excuse me, on the 1st of March 2023. Then this is the repayment. What does the repayment do to the amount you owe? It decreases the amount you owe, so you minus. And once they say interest is capitalized, what they mean is interest is added to the amount you owe. So this amount is a plus, and then you get your balance at the end of the year. Did everyone hear that, or do you guys want me to repeat? Thumbs up if you're okay with me continuing. Guys, we need to engage. I can't believe this stuff. Are people still even joined, or did the session end? Are you guys still here?
Yes, ma'am.
Hey, so my question is everyone good with how we get to the balance at the end of the year?
Yes.
Okay, I'm gonna go with that. Thank you. So we have our balance at the beginning, but now they're telling us the payment is missing. So we need to calculate that payment. That payment is important. So how do we do that? We take the 1 million, this the 1 million and 4,000, and we go backwards. What do? We now minus the interest, which is 168,000, and then we also minus our opening balance, which is 1.4 million, and that will give us our payment of 564,000. Now remember that 564,000 does what? It includes your interest. Okay. But what do we want first? We want our end, what we want our balance here. So if we look at the notes that we've been given here, they say all entries for repayments and interest have been made, and then they're telling us directors expect to maintain the capital repayments made this year during the next financial year. So that means we need to calculate what is the payment without the interest. That's what capital repayments mean. So what do? We take this we take the 564,000 that we just calculated and we subtract the 168,000, which is the interest, and that will be the repayments of the capital amount, meaning the repayments of your loan without you including interest. So 564 minus 168,000, that should give you 396,000. That is your capital repayment. Now, if they're telling us that they expect this in the next year, what does that make it? A short term loan or the current portion of the loan. So that means we need to remove it from the end of year balance. Now, how are we getting our balance? Take the 1.4 million minus the amount, this 1.4 million minus the 396,000, which does give you the 1,004,000 here. And then once you have that 1,004,000, also subtract the current portion of loan again, which is 396,000. Because now that will be going to our current liabilities. So that will be a million. Okay, explain capital repayments again. You have your loan. Let's say you go to the bank and you ask for a loan of 1,000. That is the capital amount or the principal amount. And then they're telling you that they'll be charging you 10%. So that's 100 Rand. 10% per year as the interest. So that's your interest. So now, if they talk about the capital repayment, so they're saying, let's say they say you pay for the amount for paying this 1,000 per year, you pay 110. Let's say each year you pay 110, and they tell you the 100 Rand is for the capital repayment, meaning it's for this amount, and then the 10 Rand, sorry, wait, confusing myself. Interest is 100 Rand per year. Let's say you're paying 200 per year. So of that 200, you you know interest is 100 per year. So 100 Rand will be going towards interest. So that's interest payment. The other 100, that is the capital repayment, meaning it's going towards that original 1,000 that you owe, not the 1,000 plus the 100 per year that you owe. Don't know if that's making sense. It's not the loan amount plus interest. It's just what was the original loan amount, the amount that you owed originally. That's what the capital repayment is. Going towards paying that amount, not the interest. Yeah. Vanilla, are you good? Okay, let's continue. So now we have the short-term portion of the loan. Short-term loan, and it will be 396. The reason why we don't include interest in that is because interest is calculated based on the amount you owe, like the balance. So before it was calculated using this 1.4, but now they're going to calculate it using this 1,004,000. And what does that mean then? It means that interest is going to change. So if interest is going to change, then we can't, what's this? We can't include it as in the part of the short-term loan. So we just want the capital repayment. Okay, then let's continue. What else? So now we have a new closing balance for loan. It will be the 1,004,000 minus the 396,000, which will give you 608,000. Okay. Then we go to our trade and other payables. So let's see. Continue with this information. Oh, we missed something. A transfer of debtor's balance to creditor's ledger. They're saying here a debtor with a debit balance of 8,400 in the debtor's ledger must still be transferred to his account in the creditor's ledger. That's not making sense. Debtor with a debit balance of 8,400 will be transferred to his account. Creditor's ledger. Okay, I think this was a typo or something because if they have a debit balance, that means they owe us. And let me just check something quickly. Hey guys, just be patient. Back.